get started. So really excited. This is our second or actual third part in our 4-part series of Wampum Talks. It is entitled Saving for the Future. So really excited to learn more about what we can do to make sure that we're set up for success in the future financially. So really excited to have our guest speaker on today. Next week we'll be talking about insurance and life insurance, and so excited to kind of round out our presentation about that. So bear with us today. I also want to start out by giving a quick notice. So this Saturday, if you keep up with Waccamaw Siouan STEM Studio, we will be having our second annual STEM Day. And what's really exciting about this Saturday is we're going to be opening it up to the entire community to come, regardless if you have registered or not. Maybe your kid didn't make it in. I know we have very limited selection. If you're interested in learning more about STEM or more about what we do in STEM Studio, you are more than welcome to come by between the hours of 1:30 and 3 p.m. on Saturday at the Waccamaw Siouan Tribal Grounds. We'll be out there. We'll have 12 different sessions that you can participate in. Activities will still be going on, and you can visit any of our workshops from Duke University to Garner-Webb, UNCW. We have some of our local folks giving workshops. So really excited about our STEM Day. So just want to use the opportunity to give a quick plug before we get started. So our great moderator for today is Ms. Hattie Campbell. Ms. Hattie, to know her is to love her. She's a phenomenal woman and a great mentor to so many in our tribal community. We just absolutely adore and love Ms. Hattie. She's a great pillar in our community. She's retired, as retired could be, if we just talked about her being so busy and retirement being a busy time. So just very, very important that she's a part of this today and being one of our moderator for this event. She's also a member of St. James Missionary Baptist Church. Her life's goal is to serve, and that is what she does. And so we appreciate her for doing that work. She also served on the tribal board through WSDA, and where she helped make many important decisions concerning the tribe and the community, including Title IX, Indian education. And she enjoys photography. If you ever seen any of Ms. Hattie's photography, she's an amazing photographer, has captured many amazing moments throughout our program. And so we appreciate her volunteering her time and talents to help promote and share about the great works that we're doing. She also continues to work to represent Native people on the United Tribes Board. And she has been on there for several years. I noticed she didn't put a date here, time frame, but several years she's been working with United Tribes. So without further ado, I want to thank Ms. Hattie for lending us her time today to moderate our event. Thank you, Ms. Hattie. And I will turn it over to her, and you will see me go off screen, and we'll let them take it away.
Thank you, Ashley. I appreciate it. That's wonderful. You were delightful. I'd love for you to introduce me anytime. Thank you so much. And you do so much also. It is my privilege tonight to introduce to you Mr. Daniel Nolan. He's the Chief Financial Officer for a Boys and Girls Home. And he will introduce himself and tell you what we need to do about some of our finances. Thank you, Mr. Daniel.
Thank you, Ms. Hattie. I appreciate it. And I just want to start off by saying thank you for moderating this event. Ashley gave you a good summary, and to know you is to love you, that is for sure. You've definitely helped me throughout my lifetime, and I couldn't be in this position without people like you, so thank you. Most definitely appreciate that. So as Ms. Hattie mentioned, my name is Daniel Nolan. I'm a member of the Waccamaw Siouan tribe. My current employer is Boys and Girls Home, where I serve as the capacity of as the Chief Financial Officer. So super blessed to have that opportunity. It actually brought me home from Charlotte, so super blessed to be back in Columbus County. Also, a little bit else about me, just my educational background. I have a master's in finance and investment management from UNCW. My undergrad degree is in accounting with minors in business management, as well as money and finance. So I'm pretty excited about this topic. Retirement is a big topic that a lot of people have questions about. So hopefully the purpose of this presentation is ultimately to give you guys, generalized information about retirement that'll help lead you to better roads and discussions and ultimately a better future. So with that being said, I'm going to share my screen. Miss Hattie, give me a thumbs up when you can see my screen.
Gotcha.
We're good to go. Great. So also thank you, Ashley, for putting this series together. Huge shout out. This was a huge undertaking. Want to give shout outs and praise to each one of the participating members of this talking series. So appreciate you guys and the support and making this happen for our community. So can't get into this without a little bit of financial disclaimer. Essentially, I'm not going to go word for word on what this disclaimer is. Essentially, what this means is I, nor does Waccamaw STEM Studio, solicit financial advice, or is any of this information intended for you to be advised to act on. So with that being said, I'm going to get into our topic for the night, which is savings for the future. And that word saving is a big part of our discussion, so much that we're going to use that as our outline for tonight's event. So saving for the future. You'll notice, I have a little bit of an acronym here called saving, and this is going to be the different topics that we're going to go over tonight. Ultimately, we're going to learn how to set a plan for retirement. Advisor, we're going to talk about a financial advisor for retirement. We're going to talk about vehicles for retirement. No, I'm not meaning automobile in that perspective, but more of your financial vehicles to get you to that retirement place. Investing in your future, we're just going to go over a little bit of the power of compounding interest and give you guys a little bit of examples of that. Nest egg, we're going to talk about how to save for retirement. Also, we're going to talk about get the benefits, which is a huge part of a retirement discussion that often gets left off. So I'm excited to get to that part as well. With that being said, let's go ahead and dive into this presentation. So ultimately, we're going to start with setting a plan. Setting a plan for retirement is a multi-step process. So I want you guys to just, comprehend that. Setting a financial plan for your future is something that evolves over time. It's not a sit down one night and I think this is my plan. This is something that ultimately evolves as your life evolves. And it's something that you will adjust and, go back and forth on things through different various steps of your life. Ultimately, setting a plan is a very important part of retirement. And also, retirement planning starts with thinking about your retirement goals and how long you have to meet them. So again, this part of setting a plan can be done at any stage in life. You can start in a youthful stage. You can start in the later stage of life, depending on where you are, where you fall. There's ways to adjust to get to that end goal. And we'll get to that in a second. So ultimately, one of the major considerations that I think when setting a plan you need to consider is when will you retire? Today, you need to figure out how many years you have to work until retirement. The beginning of your retirement, how many years until the end. These are very important considerations to consider. And I'm sorry if I sound a little morbid about the end of retirement or anything like that. And moving forward in this presentation, it's a little hard to do when you're talking about mortality. So please excuse me. So ultimately, this is just a good general rule of thumb. Really need to consider how many years you're willing to work and have a stable career income to save up for the beginning of that retirement date. Ultimately, these things can be adjustable depending on what stage of life that you're in, or what stage of life that you will be in. So let's not worry about right now. That's a big consideration. When will you retire? And again, this is personalized for each and every individual. My retirement date may not be your retirement date in that perspective. So just keep that in consideration. How you spend your time in retirement. This is a bunch of questions that I think are just as important, because ultimately this feeds into how much money that you will need. And we'll get to that part in a later section of this presentation. But ultimately, will you be employed in retirement? Will you work part-time? Do you want to retire from your current job and get another full-time job? Do you want to start that new career? Maybe that, stems on your passions that you may have neglected through the working years. Will you volunteer? Ms. Hattie is a great example of that through her acts of service, and she has done a lot of volunteer work, and we appreciate her for that. And that's a very important consideration that I'd push to a lot of individuals about retirement is, will you volunteer? Will you give back to the community that gave to you? Do you have a hobby? Is it a good time to start investing in that hobby or spending more time doing that hobby? Does that hobby cost money? These are also, very important questions to ask yourself. I myself, I like to deer hunt, so I know those hunting dues are non-negotiable for me when I retire. So I need to know how much that's going to cost me. What activities will you be involved in? Do you plan to travel post-retirement? These are, major financial considerations that one should really, think about in depth pre-retirement. Where will you live in retirement? So that's another question. And ultimately the answer is up to you. There's no right or wrong answer, but all these things are major financial considerations to think about. This is another map that I found pretty helpful and unique. This is just an income tax bracket by state. Not going to get into every single state, but just wanted to point out that where you live will ultimately affect, the taxes that you pay. So it's a good thing to consider and have this map. This reflects 2020 rates, so it's a little old, but it's a good general guideline on looking at where are you going to live. So for those people that want to move to Hawaii or California in retirement, just know that they're the higher in the United States in income taxes. So be prepared for that consideration when you're looking at your portfolio. Other financial impacts of your lifestyle changes are major things to think about when you're setting that financial plan for retirement. Are you making large purchases in retirement? Are you buying a new house? Are you, buying a brand new Chevrolet truck? Because those things are expensive now. Are you going to have a new lifestyle? Do you want a, new version of your lifestyle with retirement? Staying healthy, what kind of money is that going to take to stay healthy? The rising cost of healthcare is just, it's an oxymoron. Affordable healthcare, I don't think those two things go in the same sentence, but it's an oxymoron to say the least. Caring for others, how much money will that take? Like many of us, we have to have those considerations about caring for others, parents, elders, anything like that, family members that may need help in retirement. Relocating, there's moving expenses that you need to consider. So all of these are very important aspects of what you need to think about on setting a financial plan for your future. Ultimately, the goal of setting a financial plan is for you to save up the appropriate amount of money for you to be able to do everything on your plan's wish list and desires. So just keep the beginning and the end goal in mind, and just know the middle changes over time. All right, so getting into the A section, financial advisor. Retirement is, lifetime work and achievement to get to it. And just like that, with that being said, like most important things in life, we seek out advisors for help, certified qualified professionals that can help give us and formulate an opinion, help us set that plan and stick to that plan. Ultimately, speaking to a financial advisor pre-retirement is a suggestion that I would like to give to you. Many people seek financial advice from a professional, but with so many options to choose from, it may seem overwhelming to find an advisor. The first step in that is, what level of advice are you seeking? You need to determine that for yourself individually. That way you know which route that you need to go. For those who don't know what qualified financial professionals certificates look like, or professional letters at the end of your name, for lack of better words, or your credentials. A CFA is a certified financial advisor. A CFP is a certified financial planner, and a CIAM is this is a relatively newer one for me. If I'm not mistaken, it's a charter investment management accountant, if I'm not mistaken. I could be wrong on that. Ultimately, you need to determine what level of advice that you're seeking, and just understand that financial advice does come with a cost in that perspective. But again, it's one of those things, you work your entire life for something. If you don't have the qualifications, I don't recommend that you do this on your own, unless you've got your hand on everything. I'm not saying that it can't be done. Ultimately, speaking to advisors is not a bad idea in that perspective. Speaking with that advisor, you'll determine the fee structure that you're most comfortable with. And that's one of these things that I want to stop here for a second, cover, because there's different fee structures out there in the market, and I'm not sure a lot of people are aware of that. There could be a flat fee only for their services. There can be commission based, meaning when you do well, they do well, or it can be based on the amount of assets managed. So in other words, the amount of money that they're managing determines their fee structure. If you're not sure who to ask for referrals out, and through whatever your vines may be. Ask for referrals, do background checks. Once Ashley puts this presentation up, you'll notice that I've included a link to the free broker check services. So please take a look at that and just understand and get to know your advisor. This is somebody that is helping you set plan for your future. So get a comfort level with that person and make sure you're talking to the right person in that regard. Ultimately, for those people who aren't very familiar in this space, I listed out examples of what I would believe reputable financial advisors. These are companies. I didn't really recommend any individuals. You'll note at the bottom of this slide that this is not an all-inclusive list, just an example for illustration purposes. A lot of these companies should be kind of familiar to you. You probably see their commercials on TV. I know the Voya, the little orange squirrels, T. Rowe Price, PNC Bank has a great investment firm, Vanguard, Fidelity, Charles Schwab, TD Ameritrade, and Principal. Also great companies if you need that start on who to go talk to. These are the most reputable companies in this field. And again, this is not an all-inclusive list, rather an illustration list. All right. So with speaking with that advisor, we're going to get into some of the topics that you should be talking about to give you kind of that first step mover's advantage to go into or prepare you for that conversation. One of the big things that you need to consider is, what are your fixed retirement income sources? And what I mean by that is sources of income that are not going away. So a pension plan. I know many people, this was a popular retirement vehicle, is a pension plan. You work for a company for 30 years and they pay you guaranteed pension for the rest of your life. That is fixed income. It's not going away. You are entitled to that income. Social Security is also another popular variation of fixed income once you reach the qualifying years of Social Security. Other is just as it means, other, and I just want to go over a couple of examples of that. So other, maybe you own rental properties, that consistent rental income every single month. Maybe you own land that you plan to clear every 25 years, replant, clear, and do it again. Those are other, examples of what fixed income is or can be. So with that being said, before you go speak to your financial advisor, please take a review of your assets and just come make a list of the fixed things that you can rely on every single day. Ultimately, that's going to help you set that plan. That's going to help give you an idea of the income and cash flow that you can expect from your portfolio. And when I say portfolio, I'm just referring to your assets in whole, collectively. So there's also many different variations of other income, but those are two popular ones that I don't think a lot of people consider when they're making out their financial plan. Some other questions and other possible fixed income sources is former employer pension. So maybe you vested in a pension plan during your working career that you forgot about in 20 years, 30 years, whenever your retirement date is. Pull that paperwork, try to have a good memory. I think it's a good idea for anybody, starting any job, is to make a folder of the company's retirement plan and its structure and keep that in a very safe place. I would probably keep that in your personal safe. That way you don't have to recall memory later down the road. You can pull the paperwork and see it for yourself. Other possible fixed income sources, we spoke about this earlier, is part-time or full-time work. In retirement, do you plan to work part-time? If so, what's that salary or what's that hourly rate, and how many hours a week are you willing to work? Or full-time work. I know this is a popular opinion. A lot of people nowadays retire from their full-time working job and then pursue a full-time career and whatever passion that they may have. So just think about that as well, because all of these different things help you set that financial plan. It's also going to help you set that budget when we get to it at a later point in this presentation. Spouse, partner's fixed income. If you're married, take that in consideration if you weren't the sole income provider for that family. All right, speaking of Social Security, and by no means is this going to be a Social Security presentation. I just wanted to, we can't talk about retirement without mentioning Social Security. I am not a Social Security expert. I do know that you can set up an individual meeting with the corresponding Social Security office in the county that you live. And I recommend doing that before retirement. These people are there. Their jobs are to help you, kind of understand your benefits with Social Security, how it works, things of that nature. So I recommend that you take that time and go speak to somebody at the Social Security office to get all the ins and outs about this. Ultimately, for my part of this presentation, I just wanted to bring some numbers into you. As of October 2021, the average Social Security check and payment for retired workers was almost $1,600 per month, which equates to $18,700, or let's round it up to $19,000 per year. And I think we all can consider, with the price of gas, price of groceries, is your house paid for, all those different things, even a cell phone bill, $1,600 a month doesn't go as far as it used to. So that's one of those considerations that I want to bring to your attention is, Social Security should not be your only form of retirement income. If it is, kudos to you. That's not the path that I wish to take, and that's not the path that I would suggest that you take in retirement, because again, this is a government benefit and it is not one of those fixed government benefits. This could go away at any point in time. There's a lot of different interesting studies out there that you can read and research about. Ultimately, Social Security is in a deficit state, meaning that it currently pays out more than it takes in. on a yearly basis. So I'm pretty far away from retirement, so those are warning signs for me to not really make this a fixed income source for myself or a younger person. So I just wanted to bring that up. Also, I thought I found some good resources about Social Security in case you don't want to go have that conversation. I've included a link to a quick calculator that can roughly give you an estimate on what your Social Security benefits will be. You'll notice in this presentation that it is, nearly impossible to accurately predict exactly how much you're going to receive from Social Security when you retire, because the government can adjust the level of benefits at any point in time. So it's one of those things. Please go talk to Social Security administrator at the Social Security office and have that conversation, have that tough conversation, and just figure this out. I know this is a common or has been a common fixed income source in the past. With inflation as high as it is, trust me, $19,000 doesn't go a very long way this day and time. So so you'll see that link to the calculator right down here at the bottom of this presentation. So I encourage you to go out there and plug in a couple numbers and just kind of figure out where that benefit would be. I didn't include it in this presentation, and I should have on hindsight, but ultimately one of the most interesting facts I found when doing this research was that minorities and women tend to have lower Social Security payments comparative to any other person in that population. So minorities as a whole, including Native American people, as well as women as a gender. So just please take that into consideration when you are, having that discussion with your Social Security administrator. A retirement income model and expenses. So ultimately, this is a great visual that I think depicts what your retirement portfolio and expenses should, what are the things that you can consider. Flexible income, meaning income from investment plans, a stock portfolio, a 403B, which is the nonprofit version of a 401k. You can use those interchangeably. A 457 plan from your employer, a IRA, which is an individual retirement account we'll get into at a later point in this presentation. Fixed income streams that you need to consider, pension plans that we talked about earlier, constant income, rental income, land ownership or rental income, property ownership or rental income, Social Security. From an expense standpoint, discretionary expenses, meaning, what are the things that you would like to do in retirement? Necessary expenses, meaning what are the things you have to do in retirement? And what I mean by that, necessary expenses meaning food, water, lights, car, gas, taxes. And let's not forget about taxes in the grand scheme of retirement. Discretionary expenses. I gave you the example earlier about my hunting dues. That is considered discretionary, but it's necessary for me. So you can interchangeably use the two to figure out what are those necessary expenses for you individually or for a family, and what are those discretionary expenses. So travel plans, anything of that nature. Ultimately, I think this visual also gives a very good depiction of your expenses with just how they have organized the allocation of those expenses. When you're doing your setting that financial plan, you're going to come to realize that your necessary expenses are going to be your biggest expenses. So it's good. It's good to know those things up front and to map those things out over time once they change, so you know what level of funding your portfolio needs to provide to you. Ultimately, you need to convert to fixed income to cover necessary expenses from the flexible income account. So we'll get to those required distributions at a later point in time in this presentation. Ultimately, the goal is for both of your fixed income or your flexible income from assets and your fixed income streams to cover your necessary expenses at minimum. So that's kind of how you're going to set that financial plan or set that budget per se to get to your retirement goals. You need to think about your necessary expenses, your discretionary expenses, and what income sources you're going to have and how much are in those income sources. So again, this is a really good model. I encourage you, once this PowerPoint is live, is take this model and really think about it. Map these things out right beside it, or on a separate sheet of paper, Excel, whatever you guys like to use to do your budgeting. I recommend that you use this model. Knowing your annual retirement expenses. So, you know, getting into those expenses again, because this is a huge part of retirement, and it's going to ultimately, you know, dictate your cash flow of your investments and how much money you can pull and the longevity of that money over time. So knowing your expenses is a big and important part of financial planning. And I can't stress that enough, because we can make a plan, but if you don't stick to the plan, ultimately whatever timeline or time horizon your assets have will change over the course of time. So this is one of those things where you work hard for retirement and you follow a budget. Just because you retired doesn't mean that budget goes away. So we got to understand how to utilize a budget. And one of my predecessors went over budgeting. So if you didn't catch that Wampum talk, I recommend that you go back, because I did a great job on explaining how to set a budget. And that's just an important part of life that I think anybody should, you know, definitely know how to do. From a retirement aspect, though, what are your retirement expenses? Is your expense recurring or one-time expenses? What I mean by that is bills are recurring. One-time expenses, or, you know, those miscellaneous odds and ends. You know, my current vehicle is not going to last me 30 years into retirement, Daniel. I know I'm going to have to buy one more car. Well, we need to think about what type of car, how much you're willing to spend for that car, and figure those things out up front while you're working. I think that is an important part. But even if you're in retirement, have that discussion with your financial advisor. They're there to help you in that aspect. So ultimately, you'll set that plan together. It's on you as an individual to follow that plan, but they're there. They can help you make adjustments, because life does happen. We can set this financial plan thinking we're going to do one thing, and life takes us in a different direction. So ultimately, know that this is a flexible plan. Setting that plan can be flexible or have some flexibility to it, but as a general rule, it should be a plan that you stick to in that regard. How much is necessary versus discretionary expenses? How will inflation affect you? I know this is a very prevalent topic now in the financial world. This is also one of those topics that, you know, how do you protect what you saved for? And the bottom line is you account for inflation in your savings. That is one of the things that isn't going away in America. Inflation is at its highest point in quite a while. Excuse me, I don't remember the statistics, but I think it's somewhere in the 80s that we're at the highest inflation period since the 80s. So we're talking 40 years ago. So that's one of those things that you can see that hits us as individuals pretty hard, from going to the pump, going to the gas station, or going to the grocery store. Inflation, you can see it all around you. If you've tried to buy some lumber at Lowe's or any other hardware store, you're going to see that inflation and just the different manipulations of simple economics. Although COVID has been a very trying time, it's also been one of those times that really open your eyes to what the world could be in 30 to 40 years. So it's a very important thing to think about with inflation and how it affects your expenses. And I think a good rule of thumb for calculating out those expenses is set a standard or adjustable inflation rate to make sure that your savings is surpassing the inflation rate, or vice versa in that regard. ultimately it just boils down to how much money you can spend, depending if that relationship goes up or down with inflation comparative to where you set that in your financial plan. If you set a 5% inflation rate, the current inflation is 6%, that means, hey, I need to slow down my spending a little bit. I need to, kind of adjust on some of those discretionary expenses, or vice versa. Let's say you set a 5% inflation rate and inflation goes back down to 3%. You've accounted for more inflation than you did than in the market. That means, hey, I got a little bit extra money that I could spend. I'm not encouraging you to spend that money by no means, because ultimately that's going to perpetuate your funds for a longer time horizon through retirement if you have that good financial discipline and discretion in spending. It's just something to consider, something really to consider when you're making that plan, and when you're in your retirement years. Just really consider inflation. That's one of those things that a lot of people skip over when they're making that plan, but it's a very important part that should be considered. Ultimately, another part of retirement is how expenses change for your survivors. So if you're married like I am, one of the things I take in consideration is my spouse. What happens if I depart this world before they do? What situation will I leave them in? Will I leave them in a comfortable situation? Will I leave them having to enter into the workforce again? It's just one of those considerations that I think we need to say, and we really need to think about in that aspect. And survivorship's not just the spouse. That could be, your child, your significant other, your, whoever that person is or people are for you. They're survivors in that aspect. So calculating retirement expenses, I think this is a great example of just knowing your current expenses and what's your anticipated expenses in retirement. This is a good side-by-side comparison, so you can kind of figure out in an indirect way how much money that you're going to need in retirement. For the most part, for working individuals, you're going to have this pretty much mapped out already, from a housing, a food, clothing, medical costs, like all these things that we go through every single day. How much money does it take for you to live ultimately? So these are some good categories. This is not an all-inclusive list. You'll notice that in my example, the assumption under anticipated expenses is my house is paid for in that perspective. So I guess that reflects the property taxes that come every year after you pay for that house and while you pay for that house. So please take that into consideration, because working so hard for assets throughout your life, the last thing you want to do is lose those in retirement due to taxes or not being able to meet the tax implementation for those assets, cars, houses, property, land, like all those different things. So switching gears, we talked about the S and the A, the setting a plan, the speaking to a financial advisor. We're going to get into the retirement vehicle. So I gave you a good little representation or a good foreshadow about this section is, that pretty blue Corvette up top and that old reliable Toyota at bottom. So any of these vehicles are obtainable and achievable to you individually. They can be as nice as you want them and have all the bells and whistles and all the features like that Corvette, or they can be as modest as you want them from a cost structure as well, like that Toyota truck at the bottom. So ultimately, think about how much you're willing to put and willing to pay for a retirement vehicle, because all of these different things, depending on who you structure them with, will have, different cost structures. So please take that into consideration. Ultimately, the retirement vehicles that we're going to go into depth a little bit about is 401k, which should be a very familiar term for a lot of individuals. And we're going to go over the IRA, so individual retirement account. I think for the most part, a pension plan speak to human resources or accounts payable, whoever that person is at your employer, and get the plan structure for your pension plan. Pension plans are pretty simple in nature. You work X amount of years for this X benefit throughout your throughout your life, or for whatever time horizon that company offers or structures in that plan. I think it's a very good idea to know what you're working for in that perspective, know what your fixed income sources are going to be. So ultimately, that's how a pension plan works. They're a dime a dozen across different employers, and they're all different. So for more valid information on a pension plan, I recommend that you go speak to human resources or that finance person at your company and get more details about the pension plan and the workings of that plan and the constraints, because a lot of pension plans do have constraints. Meaning, when you can retire, what age you qualify for this pension plan, how many years you have to work for that company, how long this pension plan is paying out, through the end of that plan, excuse me. And another retirement vehicle that a lot of people don't consider, and I think is one of the most underrated retirement vehicles, is a stock portfolio. And what I mean by that is just, your individual stock account. And if you aren't that person that knows about stocks and bonds and how to invest, how to evaluate them, knowing what you're buying, I recommend you go speak to a financial advisor on that as well. It's definitely something that they could set up for you, or, set up a similar plan, or, ultimately that gives you the most, that stock portfolio gives you the most control over your money out of any of the retirement or pension plans that we talked about, because you have 100% ownership of that stock portfolio. I'm not dissing or, not recommending investing in a 401k or an IRA or anything like that. But from a control perspective, 401k, an IRA, a 457 plan, a 403b plan, all those different number plans are government regulated, meaning the government has rules and regulations on what you can do throughout the the life of that plan. So your stock portfolio, on the other hand, is 100% controlled by you at all times. So I just want to make that point clear for a lot of people, that's a great option to think about when we're talking about those other income sources. A stock portfolio is a great option to have in there outside of, rental income or any of those things that we discussed previously. So with that being said, let's get into a 401k plan. Ultimately, what is a 401k plan and how does it work? Essentially, a 401k plan is a qualified retirement plan that allows eligible employees of a company to save and invest for their own retirement on a tax-deferred basis. So we're going to get into that tax deferral in the next slide, and we're going to talk about pre-tax and post-tax deductions, because they have different implementations while you're working and when you go to retirement. And I think it's important to know those two implementations very well. Ultimately, one employer is allowed to sponsor a 401k. Only an employer is allowed to sponsor a 401k for their employees. So a 401k isn't something a individual can just set up on their own. It has to be employer sponsor. If you're self-employed, you can sponsor this plan for your employees, or if you're self-employed with one employee, you can set this up on your own in that perspective. But it has to go through that employer route, and that's one of those government stipulations on a 401k. Contributions are deducted from your salary on a pre-tax basis. Excuse me, I didn't catch this in my slide. There's a lot of flexible options with 401ks. And, 457 plans, essentially, I know with 401ks, you can set it up on a pre and a post-tax deduction. So when you're talking to your employer or you're going for that job interview or you're sitting in orientation, one of the things that I recommend that you get and keep in that file we talked about earlier is a plan summary. Ultimately, what that plan summary does is give you the backbone of their 401k and lets you know what you can do from a perspective of loans or contributions, matches, all the way down to things that you are pre and post tax deduction. And it also lets you know things that you can't do within that plan. So that's a very important document. I recommend that you get that, keep that in the file, understand what you're contributing to and how it's going to propel you to your retirement picture. I don't think I've said this during the presentation, so I'll say it now, is retirement pictures are, just like personal finances. Miss Hattie's retirement picture may vary from Daniel's retirement picture. So it just all depends and it all varies and it's customizable to you. This is your retirement plan. This is your retirement future. So we'll take that into consideration and, know the controlling aspects of that retirement future and what feeds into it. One of the things that I'm going to get into later is in the G section is get the benefits while you're working. It baffles me that people consider not investing in a 401k while they're retiring. Because many 401ks have employer matches, meaning they match you dollar for dollar or 50 cents on the dollar or 25% on the dollar. It just depends on the company and how they set that up. They match you at whatever rate per dollar up to 5, 10. It's an interchangeable percentage. So get that plan structure. That's going to have all that information in there to you. Essentially, it's like giving yourself a raise. And who wouldn't want to give themselves a raise? Obviously, you're not giving yourself an immediate raise. You're giving yourself a raise for the future. So, for example, the recent 401k plan that I designed is dollar for dollar match up to 5% of your annual salary. So in layman's terms, for every dollar that an employee matches or employee saves, the company will match that dollar up to 5% of your annual salary. So that's like putting in $1 and getting a $2 bill back. So putting in a 10 and getting out a 20 into your retirement account. So it's just literal free money for you, rewarding you saving. So ultimately, you're saving for the future. You're saving for future dollars, and it's one of those things that I just don't think a lot of people think of it in that perspective. But a company match on a 401k or a retirement plan is literal free money. It's giving you a raise depending on what level of savings you're willing to obtain. Obviously, with 401ks, depending on that match percentage and where you are in your stage of life, we'll get to that in a later point about, the time horizons and when you should invest in retirement. But ultimately, getting that 401k and that match, you can go above and beyond that match. I've seen people, even though it's a dollar for dollar match up to 5%, they may save 7%, and they see 12% deposited in, or a total of 12% in their investment account annually based on their annual salary. So again, I can't stress this point enough that employer matches are giving yourself a yearly bonus. That's just one of those underrated things on how I can make more money for retirement. It's simple. If your employer offers a match during that 401k, that's how you receive that yearly bonus, or that's how you create wealth above your contributions through a retirement account. Obviously, these retirement accounts are invested in different stock portfolio blends in the stock market and fixed income and equities and things of that nature. So it's not a guaranteed return on your money. So let's not confuse the two. we're talking about a match in principal, not a match in earnings or profit or loss, because you can experience both. Right now, I know that the U.S. equity market is at its lowest state that it's ever been at since the market has opened. And that is one of those things that has traditionally produced a return and produced money throughout, its roughly 60 years of being open. And it's just one of those things that COVID and inflation and all these other factors in the world take into consideration. So it just definitely, we're in a very, different financial times. I encourage you to, read some trustworthy financial sources. If you don't know what those are, they usually end in .org, .gov, or any of the above, just not a .com, and it depends on the .com. So be careful in what you're reading and what you're interpreting. But we're in a very, unique financial time that is just, very interesting stuff. I recommend that you look into it and kind of formulate your own opinion. Let's get back to this 401k. So that's how a 401k works. Let's get into it a little bit more on pre-tax and post-tax deductions. So let me try to move my screen here. It's not going to let me. Ultimately, pre and post-tax deduction is a very important part to a very important aspect of that 401k to really, consider. This is also how your benefits are deducted pre and post-tax. The tax ramifications for benefits like healthcare, dental, and all those other factors aren't going to have the tax considerations that we're going to focus on here in a second, but the math is done the exact same way. So ultimately, to explain pre-tax and post-tax, accountants and financial guys are, clever in their naming of things. It's exactly what it sounds like. Pre-tax deductions are deductions that come out before taxes. So in the example, you can see the pre-tax HMO premium coming out before your taxable income is calculated. So that's a very important thing that makes different tax implementations. Ultimately, pre-tax deductions are taxed before taxes are taken out now. Well, Daniel, I know I'm going to have to pay taxes. Where am I going to have to pay taxes on this money in a 401k if I do a pre-tax deduction? It's a good question. You're going to pay those taxes when you withdraw that money from those plans. 401ks have a required minimum distribution. So when I spoke earlier about that government control with a 401k versus a stock portfolio, this is one of the big considerations to really think about with the government control. Required minimum distributions, and we'll get into that. We'll define it and get into it a little bit. So I'm skipping ahead of myself here, but I think it's important in this topic. Required minimum distributions are exactly what it sounds like. They're required minimum distributions that you have to take from that 401k at certain times within your retirement or within your life. You can have a 401k, still be invested in that, and once you reach certain criteria, you're gonna have to make a withdrawal, whether you want to or not. And if you don't, it's gonna be a heavily taxed and heavily penalized thing for not taking that distribution. So we'll get into the more specifics about that in a later point, but I just want to let you know that, think about those different constraints that come with a 401k and an IRA. IRAs are the same way. They have required minimum distributions comparative to, a stock portfolio or something you control on your own from that fixed income aspect. But ultimately, pre-tax deductions are exactly what it sounds like. Deductions come out before taxes. So you can see that in this great example here. Post-tax deductions are the opposite of that. Post-tax deductions come out, or deductions, after your taxes are taken out. So on the opposite of pre-tax, post-tax deductions, you pay the taxes while you're working. Let's use that example, while you're working. And then your withdrawals from your retirement are tax-free in retirement with a post-tax option. So I think that's something huge to consider because, you know, I think Miss Hattie can tell us, like anybody, has the tax rate went down in your lifetime, Miss Hattie, or has it kept going up, up and up? So that's important consideration to know. It keeps going up. I'm not sure. I'm not saying that it's impossible, but I'm not sure that it's the most feasible idea for us to think taxes are going to go down for individuals, you know, when we retire. So that's one of those things to really consider. With that being said, pre and post tax deductions do make a difference in your paycheck. It makes a difference now. So pre-tax deductions are tax deductible on your income taxes while you're working. So it just depends on your different life scenario and your different life situations on whether you need that tax credit while you're working, or do you want a tax-free retirement? So it's ultimately up to you to decide which side of the fence that you want to lean on. If your employer is super friendly, they'll let you do a mix of both pre and post-tax deductions so you can hedge your liabilities in the future. And what I mean by hedge is just, you know, offset them or off-put them. So again, get that plan structure. If your employer offers a pension plan or 401k, get that information, read that information. It is very vital to the key to your future or your financial future. With that being said, you can see the difference. I'm not going to go through the math with you, but essentially pre-tax deduction dollars don't really equate to the same as dollar for dollar as post-tax. You're lowering your taxable income, therefore, and pre-tax, you're lowering your taxable income, therefore lowering the taxes taking out, which essentially, you know, you bring home more on your paycheck traditionally with a pre-tax deduction now comparative to the post-tax deduction route. So that's just one of those considerations. I can make an argument for either or, but ultimately the decision is yours if your employer offers this and gives you the flexibility to decide that. So be wise on the decision, and please make sure that you're taking in considerations of taxes, because that's the biggest thing from a pre and post-tax deduction outside of what comes home in your paycheck is, you know, definitely the tax implementations in the future. All right. And definitely with the post-tax deduction, another major consideration that I breezed over, so thank you for bringing this to my attention, Ashley, is if you do the post-tax deduction route, the assets that you put in to your 401k vehicle or whatever it may be grows tax-free over time as well. So your earnings grow tax-free. That's another implementation with pre and post-tax deduction. Pre-tax deductions, your earnings on 30 years of savings will be taxed when you draw that out, versus post-tax deductions, you pay the taxes up front, the money goes into your account, it eventually grows over time through compounding interest and, you know, making smart financial moves in that retirement account from your financial advisor or the company's financial advisor. It grows tax-free. So that's a huge, huge thing to consider with a post-tax deduction. So that's a great argument for why I should have a post-tax deduction. Yes, I'm going to miss more of my money now while I'm working, but ultimately the earnings and the earning potential is tax-free. That's just, you know, huge. So thank you for sharing that, Ashley. Contribution limits. So like I said, there's a lot of government regulations revolving 401ks. One of the biggest ones is contribution limits. You know, retirement plans aren't just, you know, guaranteed money plans. The stock market goes through cycles and goes ups and downs and ups and downs. But generally, even though it goes ups and downs in the small picture, the general trajectory is up. And you can, I think a great example of that is pull up the stock index, pull up the S&P 500, and you'll have a filter option to all. And I just want you to look at the growth for that S&P 500. So for those of you who may not be in the financial field or know what that S&P 500 is, ultimately it is a blend of the top 500, a blend of stocks with the top 500 companies in America, if I'm not mistaken. I think it's regional, but ultimately for the US, it's been adopted as a general, insight and overview, look of the economy of the world. So I just want, or the US. So I want you to look at that graph. I wish I had have included that in this presentation. I did not, I'm sorry. We can look at that at a later point in time. But ultimately look at that trajectory and you'll just see it has its cycles, ups and downs, but it generally, the general over time, it goes up, up and up. So ultimately that's how our economy has done, and that's generally how your investment portfolios will work. It will have, high points, it'll have low points. The key is not to panic during the highs and the lows. Panic and pulling out your money in a long-term investment account. One, if it's in a 401k, you're not guaranteed to be able to pull out that money when you want to. And if you are, you may have limits on what you can pull out. And there's also heavy penalties involved in pulling that money out early or having an early withdrawal. Comparative to, I'm going to just go back to that stock. The stock portfolio is something that I believe in, so I keep going back to that example. I'm not necessarily telling you you have to do that, but it's one of those things that you have 100% control of that money at all times of your life. And that is one of those things that is just invaluable, in my opinion. So again, going back to 401ks, there's contribution limits. The government sets limits to I think it's the IRS specifically. I think so, yeah. The IRS sets limits on what you can contribute and, up to how much you can contribute. So in 2022, that contribution limit, your personal contribution limit, including your employer match, is up to $20,500. So we're talking about, in the grand scheme of retirement, where we'll get into that nest egg in the future and what you should have. The general rule of thumb before COVID and kind of before 2022 was $1 million to have in that investment account or that retirement account before you go to retire. Now with inflation as high as it is, that's, arguably has gone up. I've read reports where now it's up to, some experts say $1.8 million, some say $1.2 million. So ultimately what you should have in your account depends on how you plan to spend money in retirement. That's going to dictate how much you should have in that retirement account. Because obviously you want to be able to meet those expenses, those fixed expenses, and it's always nice to be able to squeeze in all those discretionary expenses that you'd like to have. So from a 401k, ultimately the limit is up $1,000 comparative to 2021. This limit has been slowly increasing over time. I'm not aware of a cap outside of the 25 right now. What I mean by cap is an overall cap by the government, meaning they're willing to go up to X percentage in the future. That's the cap I'm speaking of. The more immediate individual cap that you and I would have would be that $20,500. For those who get into a company that offers a 401k later in life, don't worry. There is what is called a catch-up clause, which ultimately means if you're age 50 and older, you can add an extra $6,500 per year to catch up contributions and bring your retirement, your total 401k plan contributions up over time. And that sets your new contribution limit up to $27,000 per year. So that's a substantial amount of money to save on a yearly basis if you're able to do that. That's probably the best way to get to retirement if you wait till a later point in life to really start saving or have the opportunity to get in one of these types of plans. So it all depends on your personal financial situation, what you can and what you're willing to, save from a retirement standpoint. And just know that there's a catch-up clause. So if you're one of the few who are able to save $27,000 post 50 per year, then you can do that. Whereas somebody like me who's not at age 50, I am capped at $20,500 per year going into that 401k. And the contributions are generally due by the end of the calendar year. So that's another thing to consider when doing your personal finances and what you're willing to save. That cap resets on January 1st, essentially. We spoke about this earlier, required minimum distribution. So this is also another thing with 401ks, and don't misconstrue me. I'm not downing a 401k. I think it's a great retirement vehicle, but just know there are consideration or constraints and considerations to take into account when you're investing in a 401k. So again, required minimum distributions are exactly what it sounds like. They're required minimum distributions that you have to take out of the following accounts: investment plans, a 403B, a 457 plan, a 401k, and essentially IRAs all have minimum distributions. So when do I have to take that distribution, Daniel? Because that might, if you're retired or in retirement age, taking that distribution can set you in a different tax bracket depending on the amount that you have. So when do you have to take that? You have to take that distribution by December 31st. So for the most part, a good rule of thumb to think about is any minimum or required minimum distribution, or how the government looks at the time horizon on 401ks and 457 and IRA plans. It mirrors your tax year, so it's the same type of year. Depending on your employer, you can have different plan years, so it can get a little confusing and things of that. But ultimately, from a government perspective, you have until December 31st to take that distribution. What happens if I don't take that distribution? There's generally a 50% penalty if you don't take that distribution, meaning 50% of the money that you should have taken will now go as a penalty to the government. So it's one of those things that you really need to take required distribution seriously, because who wants to lose half their money because they forgot to take this distribution, or didn't consider taking this distribution, and that sets them in a different tax bracket or some other form of penalization. How distributions are calculated, we're not going to get into how they're really calculated in this presentation. I could go into detail about that. Ultimately, know that they use a uniform table to calculate that benefit. The exception if your spouse is your sole beneficiary and more than 10 years younger than you. So that's the exception for that required minimum distribution. So again, that's on a personal level. I just want you to know that there is an exception to that required minimum distribution. How you qualify for that, definitely speak to a financial advisor or your CPA or tax professional. They'll help you with that information. But just want you all to know that there are required minimum distributions. So switching gears a little bit, what is an IRA and how does it work? Essentially, an IRA is an individual retirement account. That's what it means. And I'm not necessarily it's a savings retirement account, but I don't want it to be confused with a general bank account, like a general savings account in a bank. I'm talking about two completely different things. Think of an IRA as an individual basket comparative to a savings account, meaning with an IRA or an individual retirement plan, there's many things that we can put in this basket. We can put stocks, bonds, we can put trusts, we can put all these various different things to encompass and make the basket. So it's it's a little confusing from a terminology perspective to tell you exactly what an IRA is, because it varies depending on person to person and how you set that up. But just know IRA is termed and generally termed to, you can think of it as the basket or the gift wrap or the box that you put a gift in. It is the outside, it's the thing you see from the outside. But just know there's various things that can make up the inside. So that's my best explanation of an IRA. I hope that was helpful. If not, we can, get into that discussion. I also encourage you to do your own independent research in that regard. Learn these things for yourself, because there's tons of different retirement vehicles that you can capitalize on. There's not just a 401k or an IRA. There's all these different avenues that you can take to get you to that financial goal that you want to be in. So the more educated we are as individuals, the more educated we will be about our financial future. So again, take that time and acquire that knowledge. So unlike 401ks, we're going to compare the two, because I spent a lot of time telling you about a 401k. With retirement vehicles, my best way to understand them is comparing one to the other. Unlike 401k, the most common types of IRAs are accounts that you will open on your own. So your employer will not offer you an IRA account. This is something, just like the title says, an individual retirement account. This will require you to go outside of your traditional employer. This is something that you individually set up. So an IRA is achievable to every single person, saving for retirement. And there's different variations of that IRA: traditional IRA, a Roth IRA, and Roth meaning post-tax, so meaning tax-free growth in that IRA account. So they're a dime a dozen, and just read into what you want to set up. I truly suggest that you do that. There are several different types of IRAs. Unfortunately, not everyone gets to take advantage of them. That's another thing. Each has eligibility restrictions based on your income or your employment status. So there's tons. Everybody can set up an IRA, but not everybody can set up the specific, that's why there's so many different variations to make that more achievable for the average person, or for essentially everybody, excuse me. So please do your research on what you're eligible for, and how much you contribute each year, and the penalties in most cases for yanking the money before retirement age. So again, just take those considerations when you're thinking about what an IRA is. This is not an all-inclusive list of the IRAs, but for this presentation, I just wanted to give you, the top three IRAs. You have a traditional IRA, which is essentially, it's just more of your traditional based IRA. I don't want to read the definition, but I do want to read the highlighted point. Many retirees find themselves in a lower tax bracket than they were in pre-retirement, meaning your level of cash flow generally goes down post-retirement. You don't make the same amount of money. So there is different tax deferral rates for this money, and it may be taxed at a lower rate depending on which tax bracket you fall in. So again, IRAs are great. There's a lot of tax deferral, built-in tax deferral mechanisms. So I suggest you do your research into that. We kind of got into a Roth IRA. It's think about that kind of post-tax relationship we discussed earlier, and tax-free growth. Essentially, a Roth IRA, the huge benefit of a Roth is tax-free growth within that plan. And with tax-free withdrawals in retirement, provided that certain conditions are met. So you'll have to do some more research on what those conditions are, make sure you meet them, but a Roth IRA is another great alternative to a post-tax deduction 401k. And then a rollover IRA, which is essentially what it sounds like. You're rolling over assets from XYZ eligible plan into an IRA account. So I'll give you an example of that. Let's say you have a 401k you may have forgotten about from an employer, never rolled those funds over. They've just been sitting stagnant for X amount of months, days, years, whatever whatever the case may be. A rollover IRA is essentially you're rolling over those funds from that stagnant retirement account or from a active retirement account, depending on the distribution and how you set that up. Ultimately, you can roll those over into another retirement plan. So one of the key points to any financial discussion is diversity in your portfolio. This is how we diversify our portfolio, is having different variations of stocks, bonds, and investment accounts, but we can also diversify the structure of our accounts to help us through whatever phase in post-retirement. So again, diversity in your portfolio is not just having different stocks and bonds, but you can also structure diversity from a plan itself, meaning I can have a pre-tax 401k and I can also individually set up a Roth IRA. So I can get the pre-tax savings on my earnings and my income while I'm working, and I can also save for a Roth IRA account with post-tax dollars. So again, you can mitigate your risk and set these up, depending on your individual level, what you may be willing to pay for and what you may be willing and wanting to achieve. So I strongly suggest speaking to a financial professional about the different types of accounts that you can set up. So switching to the I, and we're almost done, so please bear with me. This is going to get a little quick from here. So speaking to the I, investing in your future. So I just want to speak on just some of the basics of time, money, and value concepts. Time, money, and value is essentially how money changes over time. This is something for those who want to go into the finance field. This is the root and the basis of all the calculations that you're about to do through all your, different studies or moving into the future with that professional career. And I want to explain just a basic understanding of time, money, and value that we can agree on. Essentially, the present value of money is greater than the future value of money. And think about inflation when I'm saying this. So $20 now is greater than $20 30 years from now. And I think, Ms. Hattie, you've probably seen this over your lifetime, where a dollar back then was way more than what a dollar is now. So that is a general rule of finance. So just think about that now and think about that present value of money with your pre and post-tax deductions, because it does, make different financial pictures over, a course of 30 to 45 years, however your, time horizon is, 5 years to, whenever that may be. But ultimately, no, the present value of money is greater than the future value of money. The present value of money could be invested when in hand for better future returns, versus on the future side of that, the future value of money, the same amount of money is subject to uncertainties, meaning inflation, other, financial uncertainties that we can go into. Your plan might change and that future value of money may not be what it, is. The value of a dollar could drop significantly over my lifetime. So it's just, those are the things that are uncertain and we can't control with the future value of money. So I hope that is a good, insight to the time value of money concepts. And essentially, please do some research on that on your own. but essentially time value of money is how money changes over time. These simple concepts are, very important. And I think this is, the basis of how do I make my money work for me. Understand time value of money. I'm not telling you to be able to calculate it, but understand the general concepts of money and how it changes over time and how you can put that money into certain financial vehicles that will ultimately help your money work for you at a certain point in time. That is one of the, wealth mindsets. And I'm sorry, I'm just going to put it in layman's terms. On the opposite of wealth mindset is, a poor mindset where I work for money constantly. At a certain point, if you are able to financially reach this, you need your assets, your money to work for you. So again, this is one of the basis of that concept. I think it's a really good, thing for any individual, whether you're in high school or really close to retirement. I would say there's not really, a bad time to learn these concepts and understand how money changes and grows over time, or how it can grow over time, and vice versa. So speaking of savings in itself, we went over the vehicles, setting a plan, speaking to a financial advisor. And like most financial advisors, the earlier you can start saving for retirement, the better your retirement picture will be, whatever that picture may want you may want it to be. So ultimately, the power of starting an early savings. So we're going to get in some of those, time, money, value concepts, but we're just going to look at it from a picture standpoint. Ultimately, this graph is built on how to achieve $1 million, hypothetically assumes a 6.5% annual return. And obviously, for illustration purposes, this does not account for fees or taxes on an individual level, or from a fee from a retirement vehicle structure or investment fee. Ultimately, this is just to give you a picture between years. This is on 5-year increments. So from year 20 to 25, you can expect to save $310 per month. Don't worry, if you're closer to retirement, you can still achieve that $1 million portfolio, but it's going to cost you a lot more later in life. And you can see just the exponential growth of that curve model, and that exponential growth is due to compounding interest. And you're seeing the shift of how money works for you at a certain given point in time, and the time horizon you can expect for that money to start working for you just sitting in an investment account. So it's one of those things, slow and steady wins the race through compounding interest. Compounding interest is exactly what it sounds like. It's interest that compounds upon itself over a period of time versus simple interest. If I'm not mistaken, I think Monica may have covered that in a previous presentation. So for time purposes, I'm just going to leave that there, but just see the visual aspect of how money grows over time when given the opportunity. This is another great example of investment growth, and this is just kind of where you would expect. I thought this was a good, different individual or different individual study on, I think it's 3 individuals, years 25, 35, and 45. They all invest the same amount of money each month, but it gives you the breakdown of what they're going to have in that retirement account. So you can see Jack, who invests $2,200 per month starting at age 25, contributes a total of $96,000 to his retirement account. But through natural attrition and natural growth and compounding interest, has well over $500,000 when he goes to retire at age 65. Linda, on the other hand, starts investing at $200 per month starting at age 35, and contributes a total of $72,000 to have, let's round that and say $250,000 in retirement. So over a course of 30 years. Jack, you see on the flip side, started early, has about a 40-year time horizon to let that money start to slowly but surely work for him. And you can see that he put in $96,000. So he puts in more over his lifetime, but the general portfolio growth is greater than any scenario that we compare to. And Bill invests the same $200 per month for 20 years, contributes about $48,000 and has around $100,000. So that money hasn't had the opportunity to work for Bill as the same it did for Jack. So ultimately, if I'm later in life and later to retirement age and I want to start investing and reap these benefits of compounding interest, how do I do that, Daniel? How do I catch that back up? The simplest way is you have to contribute more. That's, an unfortunate truth comparative to if you were to start investing early. So investing early does have its benefits. I know for a lot of young people, maybe not myself because I wanted to go into this field and I learned about this relatively early, but investing early has its benefits and it will pay off when you go into retirement. If life goes a different direction and you don't have the ability to invest in one of those financial vehicles that we talked about earlier, then just know in order to catch back up, you're going to have to raise the amount that you contribute to catch back up in a shorter time horizon, and you're still not going to have the same compounding growth because that takes time to achieve. Another thing to take into consideration about retirement is always we got to set that end goal. I know this is a bit of a morbid subject to talk about, longevity, so I'm not going to dwell on this too much or go into too much detail about longevity. Ultimately, this is a really good study from the U.S. Department of Health and Human Services from November of 2020 that goes into the mortality tables, what I would call current mortality tables. It's probably more updated information, but I thought this was a really good example of what we needed to see here. Ultimately, how do I read this chart, Daniel? This chart is giving you four different examples. Males, age 55, females, age 55, males, age 65, females, age 65. Ultimately, the yellow bar is 50%. So 50% of males age 55 can expect to live, somewhere north of 80, let's say 81, 82. 25% of males age 55 can expect to see, to live into their 90s. And then you have the 10 percentile. So, the 10% of people or males age 55 can expect to live to their mid 90s. So obviously you need to take in family health into this and your individual family and genetics, and you can alter that timeline accordingly, but this is ultimately how you read that graph for male, female, ages 55, 65. What this graph tells me right off the bat is women tend to live longer than men. From a statistics standpoint. Ultimately, you can kind of see that with the volume between male and female. So ultimately planning for longevity. So knowing how long I need my money to last me in retirement. All right, so we're going to switch to the next subject is nest egg. And ultimately from a financial and just a general definition standpoint, when I'm referring to a nest egg, I'm referring to large sum of money or sums of money. And just like that nest egg and those golden eggs, these are things that we need in retirement to get us to those goals. And saving for retirement is often referred to as growing your nest egg. So if you don't have those eggs yet, saving through different financial tools is how you accumulate those eggs. And again, diversity is a huge subject in finance and in any portfolio. And just like saving for that nest egg, we don't want all our eggs in one basket, because things do happen in that perspective. So we can look back into, I'm sure a lot of people on this call or listening to this call have lived through that '08 financial crisis and are now living through the unprecedented financial times of 2022 post-COVID, or in that perspective. So again, having different eggs is a great thing in that regard, and it's called diversifying your portfolio. So with that nest egg, what should you aim to save for savings wise? So essentially, I use that $1 million as a good reference point. Let's get a more specific percentage on your savings. Ultimately, there's a rule of 72 in the finance world, and I'd be doing you a disservice if I didn't tell you about that. Ultimately, what that means is you save as much as you would need to get 72% of your salary for about 20 years. That is the general rule of 72. With inflation, you can argue that it can be a rule of 80%, depending on how much money you make during your working career. You can kind of adjust that with your expenses moving forward and make that percentage specific to you. I please recommend you do that. Ultimately, from a lot of financial articles that I read through, they think it would be a good idea for a person that makes about $75,000 per year to have about $1.2 million in their savings account if you don't factor in inflation. If you factor in inflation, that number goes up to around $1.5 to $1.8 million, depending on how you factor inflation in. And a lot of this with inflation also predicated and is dependent on your spending habits in retirement. So again, those discretionary expenses versus those necessary expenses. With inflation, one of the most relevant places to see that now is going to the grocery store. We all have been to the grocery store lately, and we know it doesn't take much to get that little cart up to $100. There might be a bag or two now compared to 15 years ago in the grocery store. $100 was a cart full. So just take that into consideration when you're doing your savings for retirement, and please factor in a base inflation rate at minimum. That would be the easiest way to do so. One of the more, elevated ways to factor in inflation is factor it in on a discretionary changing basis, meaning it goes up X amount percent each year. But the main thing that we can agree on and how much you should have on savings is it's a lot of money. We're not talking about $10,000, $15,000 for retirement. It could be, but your retirement picture would look a lot different comparative to somebody with $1.2 to $1.8 million in their retirement accounts. Not just one, not just singular, plural in that perspective. So withdrawals from investments, so tapping that nest egg. Not only do we need to grow our nest eggs, we need to control our nest eggs, and tapping those nest eggs and having basic withdrawal strategies on when I'm going to pull out of what pot are very important to how you tap that nest egg and prolong that nest egg nest eggs over time. So do you plan to live on the interest and dividends only? Will you also access the principal? We'll get into a chart that'll do a great explanation of why that is a big consideration here. If I'm not mistaken, I think it's my next slide. So we'll get into those questions in a second. But ultimately, another big question is how much income can your investments provide you? So again, now I'm not talking, when I spoke about financial advisor, I'm not talking about a one-time discussion. If you set up some sort of or have some sort of retirement account, I recommend that you speak to your financial advisors often, because life does change, daily by the hour. My breath now isn't guaranteed to be breathing in 15 minutes. So life does change unexpectedly. So we need to know how much income can our investments provide us. It's always good to know what's your max and what's your realistic withdrawal in that perspective. There's a lot of other great questions that are in here, but for time purposes, I'm gonna limit it to those two only. Establishing payments is another great thing to talk about, because this also, we've hit on this discussion again. This is tapping that nest egg. Establishing payments from your asset plans also have tax implementations on which tax bracket, depending on what assets that you're drawing from and how you structured those from I'm gonna just go back to a simple term I think we all can relate to, as a pre-tax and a post-tax deduction. So understanding how you're drawing the money and what account you're drawing it from is going to be a huge consideration when you're protecting and prolonging that nest egg, because certain things might, be designed to expire. I know for my personal retirement, I'm going to have certain, accounts that I'm just going to draw and plan to expire those accounts. Now, I'm not saying I'm expiring all my nest eggs, but over the course of, let's say Lord willing, I have a very long retirement, 40-year retirement. I would love that. I'm going to design things to fall off at certain periods of that retirement, just so I make sure I'm getting all the benefits that I worked for through my life, and doing so in a way that makes it tax advantage for me as a user, me as my family, all these considerations, and making sure I'm doing it in a way to not price myself out of getting the help that government does provide, like Medicare, or any Social Security, or any of those things, government benefits that are offered for and designed for retirees in that perspective. So definitely understand how you want to tap those next nest eggs. This is a great topic of discussion for your financial advisor. They'll help you set this up in a tax considerate basis for you as the individual. 4% rule, preserving that nest egg. So as a good general rule of thumb, 4%, if you don't know about, these tables we're going to get into in a second, 4% is the general rule on what you need to withdraw from your retirement account to prolong that at least, 30 years perspective. So here's how it works. You start by withdrawing 4% of your nest eggs, which means the value of your investments earmarked for retirement. You withdraw 4%. Ultimately, why is it 4%, Daniel? Is that's a more conservative percentage in comparison to average returns on your investments. So meaning your average return may be 10% per year. So if I withdraw 4% of my overall plan, I'm only withdrawing my earnings. I'm not withdrawing my principal and earnings. So know the difference. That's a very good rule to think about. It's not the only thing out there, and it's not one of those rules that is just cut in stone. This is what I need to do and nothing else. Ultimately, depending on longevity, family history, how much you've saved, you can manipulate this rule and make it work for you. So getting into that is, how many years will your assets last using both income and principal? So I talked about this, draining that nest egg. So this is a great table. It'll be available for you through this presentation. And if I'm not mistaken, Ashley's going to post these presentations and PowerPoints somewhere for you guys to refer back to at a later point in time to really comprehend this data, because I will acknowledge I've talked about a lot. I've scratched the surface on a lot of different financial terms, tools, and vehicles that, will take some time to digest if you're not already familiar with them. So ultimately, how you read this table is the withdrawal rate on the left and the rate of return, meaning how much your assets return. And obviously, this rate of return is positive. Just know that your rate of return is not always positive. I mentioned earlier that U.S. equity market actually losing money and being at its lowest point since it virtually opened. U.S. equities are one of those fields that have always traditionally had positive returns. And now we're seeing through various different factors I'm not going to get into, we're seeing those markets lose money for the first time in its existence. So just know when your rate of return is negative, that means your withdrawal rate should be lower to preserve that nest egg. Now, when your rate of return is positive and you're killing it, you're knocking it out of the park and you're getting a 10% return, you can afford to, withdraw more of a percentage from your account. So, I would say don't look at this on a monthly basis. I would use this as an annual calculation to really, one, don't stress yourself out during retirement, and two, an annual percentage is, how most of these accounts work in this industry is you look at annual percentages. So from flipping from retirement to an endowment or any other large investment pool, you review that percentage annually. So ultimately, this is a great table, and I've highlighted a couple examples that I want to go through. So if I have a 6% withdrawal rate and a 6% return rate, and I withdraw 6% of my assets, I can expect my assets, meaning growth and principal, to last me 22 years. Now, the power of a withdrawal rate is I take that same 6% return and I withdraw 2% less. So depending on how much assets you have, saved up, it could mean a substantial withdrawal deduction. But in the grand scheme of things, 2% less, I can make that money last for nearly twice as long. So just take that into consideration when you're talking about a withdrawal rate. That's the power of knowing these rates and how they work in the real world, and how you can preserve your nest egg. This is obviously something you need to know while you're in retirement, but I think it's something very good to consider if you waited later in life to start saving for retirement, is know how these withdrawal rates work and with the rate of return. So again, I think that's a great example. Obviously, I've had to have some assumptions to calculate this out. My withdrawal rate is based on the first year distribution and subsequent distributions increasing by 3.5% for inflation. So this table is taking into consideration compounding 3.5% inflation for every year. Or excuse me, I'm sorry, I read that wrong. This is taking in a flat inflation rate of 3.5%. All right, so ultimately know how you can drain your nest eggs. That's a very important part of it, of retirement and being in retirement. So again, not to breeze by this conversation, but each one of these topics that we could discuss could be hour-long discussions with your financial advisor, depending on your personal comfort level with this information, as well as your personal knowledge of the subject matter. So please be an informed investor, and do your research, as well as reach out to professionals when applicable. All right, and G, for our last subject and wrapping this up, this is a huge part of retirement that I think not a lot of people, and including myself, haven't taken advantage of getting the benefits while you're working of your employer sponsored benefit plans. So preventive maintenance now can help you improve longevity and promote overall better health for you to enjoy that retirement. So what I mean, I'm just going to use one good example, is that healthcare plan. Nobody likes to go to the doctor, or I'm gonna speak for everybody because I don't like to go to the doctor, but Daniel doesn't like to go to the doctor. So sometimes Daniel doesn't go to the doctor. Don't be like Daniel. Use that healthcare plan. Go get that annual checkup. Go get that annual physical. Go to the dentist. Get those cleanings. Go do all these things that you're paying for from a deduction standpoint, and your employer is offering you at a lower cost than it would be in the market. Go use those while your income is high, while you're working, because traditionally you're for the most part, and for most of us, our income will be lower in retirement comparative to when we're working. Unless we come into a boatload of money, that's the general case for most people. Your income is lower in retirement than you're working. So why not use those incentives and those lower pricing and those conglomerate price points that your healthcare provider through your employer gives you while you're working. So healthcare, again, we talked about it being an oxymoron, affordable healthcare, and that's really an oxymoron. Anybody who's been through things with the healthcare industry will tell you that is not affordable and that for the average person, and it does generally cost a lot of money, but ultimately healthcare is one of those expensive goods and costs that is only rising. Just my personal opinion, I don't see that cost flattening out anytime soon or going down. It's only going to continue to rise as long as we have a for-profit healthcare system. Using growth group buying power. So again, this kind of helps you, your employer may offer discounts on certain medicines and things like that. Traditionally, Native Americans have, genetic disposure to certain diseases, high blood pressure, diabetes, all of those different various things. And you can even get to more of your specific family dynamics. Prevent this now so you can perpetuate your retirement and ultimately, improve your lifestyle while you're working. Get those benefits while they're offered and while they're working. So again, to wrap up this conversation about retirement and going through that savings acronym, we really touched on a lot. I appreciate your time and your patience as I navigated through those discussion points. It's very complex information. I suggest, digest this at your own time and own leisure once those things get over. So with wrapping that up, I'm going to turn it back to Miss Hattie. I appreciate your time as well. So thank you. I'm going to turn it back over to you for questions so we can wrap this up. Oh,
thank you. Thank you so much, Daniel. You have done an amazing job. I wish I'd have had that before I retired. I really needed this information. And I hope people will use this information to better see their retirement in the future. Those that have not retired, that still have time to plan, because I didn't have all this information and I really appreciate it. I have a few questions, not many, but I have a few because you covered a lot of material. Okay. And so I don't have too much. I see I have the first question, how to save for uncertain future. We having a time with the market going up and down and grocery. And I think you touched on that somewhat too, about yes, how do we save for a future that we're not sure of, like it was 40 years ago.
So to answer that question, you can, it all depends on what you want your retirement picture to look like. And what I mean by that is, what do you want your retirement to look like? Are you going to have any of those, lifestyle changes? Are you going to, Not saying that it's bad. And when you retire, do you want to buy that shiny new red Corvette? It all depends on, those factors. You got to take that into consideration and what you need to save for from retirement perspective. I think a good picture now to kind of understand what you need to save for retirement is look at your current level of income. What are going to be your fixed expenses? So food, lights, all those different various things. And how much of your check is that in a percentage point? So come up with that percentage. You might want to build in that padded cushion for that uncertainty. I think that's, not just understanding the base minimum percentage that you need to have, but I think a good idea for an uncertain future is one, when you're doing your retirement savings, understand the value of $1 now compared to a value of $1 20 years, 30 years in the future. Comparative to understanding how money works will be a great, start, knowing that that $1 now is worth more than that $1 in the future. So meaning count for inflation. So, just for those, and you can speak to your financial advisor or whoever that person is, but, almost deflate the value of your $1. So that way you have more dollars in the future comparative to the base minimum. Did I really answer your question?
You answered the question, and you did I need to do like a little follow-up with that question. How do one contact a advisor? Do we pick up the phone and call one? I see you listed all of those companies. Do we call those companies?
Yes, ma'am. So you can definitely call them. I know COVID's a very prevalent thing now. You can reach out to them via email or call them, schedule an appointment. There's a lot of those companies now that are in lieu of, obviously they'll meet you in person if you want to have that in person and you're used to that format and discussion. A lot of companies now offer virtual sessions as well. So through whatever media platform that they have, Zoom, GoToMeeting, any of those web-based chat services like we're doing now, you can have that conversation there. But how do you contact them? You can call them, you can pick on the phone, you can go to their regional or local office and walk in the door and start that discussion point. In that presentation, for those people who aren't very familiar or may not know a referral source, I put in a link to a national database, and you can look these companies up for yourself, pull up SBA and get a good review of their business. So the Small Business Administration's website, and type in, if it's not a national firm, that I put in more national firms in that pictures for more reputable, national entities. There's local individuals. I'm not dismissing that hardworking individual who has these certifications that wants to do this. So maybe meaning somebody like me that might want to open my own firm one day. Not dismissing those people because they have, amassed a wealth of knowledge as well. So ultimately, how do you pick them? It's just as much an interview for them as it is for you. So ask questions.
That's some great advice. Thank you. Let me ask you this. Should I or should one invest in a 401k? You really been pushing that with the 401k. Do most people know about the 401k, or if the company has a 401k, do they put that information out there?
Yes, it should be one of their selling points to get you to work for their company. A 401k is, for lack of better terms, a employee-driven, employer incentivized plan. So what I mean by that is your savings in a 401k is employee-driven, meaning me as the individual, I drive that with the level of savings that I, want. It's employer incentivized from a match perspective on whatever matching principle that they have in place. So I would like to live in a world where most people are familiar with the term 401k and kind of have the correlation, oh, that's something to do with retirement. They might not know the specifics about that account, but I think it's a more prevalent term now that people are understanding. So should you invest in a 401k outside of alternative investments? So like real estate, even NFTs, any of those alternative, really not stocks and bonds. 401ks are the most reachable employer offered investment account.
Okay.
So I think it's a good general rule to have a 401k. That's pretty much from a financial perspective, one of the major major retirement accounts that you can have is that 401k. Should you invest? We're all grown individuals. I can't tell somebody what they should or shouldn't do, but I think it's a good rule of thumb to invest in some sort, maybe not. There's all kinds of different retirement vehicles that we touched on, or that I didn't touch on. I just covered, a couple of the major ones in this industry, but I think it's a good idea to really grow your money. And I spoke about the S&P 500, and I think, Miss Hattie, if you can bear with me a second, I'm going to pull that up and share my screen because I just want people to see how stocks have really perpetuated individual and, GDP growth over time. So I think that's a great segue for me to really pull this up and show you what I'm talking about. So let me pull this up. And I will share my screen, Miss Hattie. So give me 1 second here and I'll be real quick in my explanation of this. So I am sharing my screen now. I'm going to try to zoom in. It's not letting me do it. Can you see this graph essentially?
I can see that.
Okay,
Yes.
Great. This is what I'm talking about. So S&P 500 and the index tracker is listed right here. So if you want to look that up on your own, you can do that. Let me cancel out of here. I have filtered it to the max. So meaning the S&P 500 index has started in September 17th, 1982. So we're talking about 40 years.
That's 40.
40 years. So we're looking at that. So 40 years ago, Miss Hattie, $122 per share. That was a lot of money, wasn't it?
Yes, it was.
It was a lot of money. But ultimately, I want you to see how you're going to pick up on two things in this, but you're going to pick up on two things in this kind of visual. One, you're going to see the value of a dollar change over time. So $122 now, it's currently trading at $3,900 per share. So that's how much dollars can change over time through inflation and other various items. But ultimately, I want you to look at this graph and just look at it over time. And I may step on some toes by saying this, but if I didn't have I often, being in the finance, I often realize like, man, I wish I had this knowledge and was born 40 years ago, because you didn't have to really know a lot about investing. You could have literally used an index fund like the S&P 500, put all of your money. Now, before I go into this, I'm not recommending that you do this now.
Understand.
Please preference that.
Understand.
But you could have put all of your money in this one index fund and just look at it grow over time. I often spoke about those mini lulls, and we're going to zoom into let's just zoom into a year to get a good picture. You're going to see those lulls over the year, right? It goes up and down, up and down, up and down. But look at this January to May to September. Just remember those dates, January to September 2022. Now let's step back and look at it at the grand scheme of time. So we're still talking about the same points in time. But again, look at that general arc. Now it goes up, and it goes down. It goes up, it goes down. It keeps going up. So look at that trajectory of growth since the '08 financial crisis. And not a lot of people are even aware of this huge spike in gross domestic product in America over a relatively short period of time. I'm not going to get into the factors and kind of my, analysis of what that is. But again, just look. Now, all those lulls and growths that we just talked about from January of 2022, I'm sorry, I'm trying to match it back up on here. January of 2022, we're talking about this part of time in the grand scheme of things. So when we look at the micro picture and look that down from a year, from the past year, it looks pretty bad, don't it? That red don't mean good. If I know green means go and red means stop, that red don't look good. And you can kind of see the general trend has been down the past year, or even for the past 5 years. So getting into COVID and the government shutdowns, you'll remember March of 2020 for the rest of your life when the government started shutting down, businesses and all that. And even talks leading up to it, you can kind of see how it affects the dollar and, affects the stock market prices. So you can literally observe these trends over, different financial things that we can see through the news and other various media sources. And since COVID, it's been hard for inflation, and we're in our highest inflation point, but look at the general growth in an index fund from literally at its lowest in 2020 $2,300. We're talking about the same index fund, $2,300 less than 2 years ago, now trading for $3,900. I'll take that return.
I'll take that one. I'll take that one.
So I hope that answers your question. And
it answered my question, and it's a good question to ask because a lot of natives do not know anything about the stock market.
Absolutely.
So we really thank you for the privilege of giving all this information to us. Let me ask this, and I'm going to kind of wrap it up. What age should I begin to save, or a young person needs to start saving?
Well, I think the concept of saving is a term that, obviously toddlers probably won't comprehend this, but not with money. They can comprehend it on other levels from a saving, like, hey, don't eat all that cookie now. You'll have some cookie later.
Right.
We can positively reinforce, the concept of savings at a very young age. And then, as that person, matures and, their mentality matures in that perspective, and also their cognitive development, we can kind of transition it to dollars. So I think the concept of saving can be taught rather early in life. Now, when we get into retirement, specifically what age should I retire or start saving for retirement? If you think back to that slide about our 3 examples, I think can't remember, but it was the green line that started saving the earliest. You understand the earlier that you save, the less that you have to fund it throughout your working career, because you're funding it longer, right? You follow me there? So the earlier I save, the less money I actually have to put away. And the less money I have to put away obviously transitions to, once that 20-year-old person or 18-year-old person gets a family and starts all that stuff, they're going to need that money, right? Who can afford to save? I think my age category was like, telling my age here, but I think it was on that chart was like $690 or something like that. And I'm thinking, like, what person 30 to 35 years old that went to college can afford to save $690 per month? One that doesn't have a vehicle payment, obviously that's a given, but for the most part, when you're in that age, the car mom and dad bought you is probably needing replacing by age 30. So you're probably going to have a car payment, or if you can outright buy a car, all means go for it. I couldn't do that. So I got a car payment and other bills, a mortgage and, phone bill, all those different things. So ultimately, to answer your question and summarize that, the earlier you start, the better off you'll be. The later you start, the more you'll need to fund it.
That's
The more
understood.
you'll have to have the ability to fund it.
Okay. One last question. This is it. You talked about survivorship, and do we, as a person who's retired, do we need to make a will? I know this is not, it's kind of out of category. Do people who are retired need to, you talked about the mortality rate, and we know as we get older, we're gonna leave here. So do we need to look out for our spouse, our children, our grandchildren, or what have you?
I think it is acknowledging, yes, my next breath isn't promised, right? So with that same mentality, I think it is a good rule of thumb to have your affairs in order while you have the cognitive mindset to do so. Because as you know, the older you get, the less cognitive function that you may have. I'm not saying that that will happen to you, but the likelihood of it happening is higher with your age, growing in that perspective. And I mean that respectfully. But ultimately, it is a good general idea to have those types of documents in order for those in lieu of having an actual will for you'll need your will for more of your individual controlled asset pool. So your stock portfolio, that'll need to have a will, or that'll need to be mentioned in your will at some point in time, because you have 100% controllership of that. From more of a more regulated plan, there's natural built-in, kind of terms of a will, meaning your beneficiary. You'll set those up, and that's essentially what that means, Ms. Hattie, is you're setting that up in lieu of the will or some legal binding document. So as a good rule, I think it would be good. We're talking about setting a plan and organizing. So the main constructs of having our stuff together pre-retirement, I think it would be a good idea to go ahead and have the legal paperwork to back that up, just to make it easier for those survivors, right? Or make it well defined for them.
Thank you so much. You are a vessel full of information. Thank you so much. And you did an excellent job presenting. I will go back through this and share it with you. Thank you so much. And I hope everyone else got as much as I did out of this. Thank you so much, Daniel.
Thank you for your time, Ms. Hattie. I appreciate it. Thank you for being a staple of this tribe and the St. James and Buckhead community. We love you there too. So thank you very much.
Thank you.
All right.
Awesome. Thank you all so much. We appreciate it. And I obviously have a cameo from Logan to be a part of the video. Daniel, before you go, and I know we're kind of we're a little bit over 2 hours here, but a lot of you just literally hit on, I think that it's a testimony to the amount of depth that you can go into. If anybody takes away anything, I want them to take away the fact that there's a lot more to retirement than maybe what meets the eye. And at least we'll probe you to go out and learn more about this. And now you have a little bit more knowledge. We're going to post this out to our YouTube channel as well this week. So it'd be really great if you can go back, like you said, Ms. Hattie, and rewind this a little bit and spend more time and take some good notes. Like you were taking a lot of great notes. And then we're also going to be posting out later on this month a new location that will house our the PowerPoint slides that Daniel shared. This conversation is really important. I know that whenever we talked about this, we talked about Native people being very skeptical about and putting their money into places that they can't see. And so a lot of times that plays out where we'd rather buy land or buy an investment property or another home that we can tangibly see and feel and touch, and we know that it exists. And so it creates a lot of skepticism around the market. And I think Black Friday is what my parents have shared, has been one of the driving factors to that. And so I know that you kind of touched on that a little bit, maybe not calling it that, but just looking at the market over time of how it's been able to recover.
So just to make sure, so one, to kind of answer that question, Ashley, and go into it a little detail, I understand the uncertainty that goes along with having assets that you can't physically touch. I'm not going to get into this too much, but I think since Nixon and the creation of the stock market in the 80s, ultimately what happened in the US is we went from a gold standard on the dollar, meaning we have enough gold to back every dollar in that bank account, to a more stock-driven system. So that's why the gold standard was repealed back in the 80s, is to transition into a more virtual form of, and obviously growth potential for the American dollar. You can kind of get into that a little bit. We can have our own discussion on that and go into a lot of details about it. But just know that the gold standard hasn't been a thing for 40 years, and I'm not sure a lot of people are aware of that and what that means from an implementation standpoint. And I'm not saying that having that piece of land isn't a good, valuable asset to have, because hey, that's one of my plans in retirement. Is I want to have my own hunting preserve, so that I don't want no emails, no cell phone service. You can find me in the woods on my tractor doing what I want to do, no interruptions. That's my retirement goal, right? So I understand having that piece of land, and then with that piece of land, you got to take into consideration, timber prices and stuff like that. You go to Lowe's and a 2x4 is $40. Well, that 25-year-old pine tree that's been naturally growing on my piece of land is going to be worth a lot of money. So I can't discredit, those forms of retirement, having that physical asset. But I don't want to discourage from also having assets that we can't physically touch. And I think a great example of that is your bank account. People don't want to really realize that or not. But you can't go, if you got a certain dollar amount in there, let's say, you just can't go to Truist or State Employees Credit Union or Regalwood Federal Credit Union and tell them, I want my $100,000 out of this account now. You can't do that. It's going to take time. It's going to take them at least a week to be able to fund that. And they might give you the option that, sir, you can't pull out all of your money into this account. So unless you have physical cash in your hand, you are willingly or unwillingly participating in the system of having virtual assets. So I think that's one thing that we can talk about. I think that's a very relatable example to getting into it. You can see, and maybe a lot of youth can tell you, maybe the older population, about the spike of crypto and the move to a virtual currency. Well, right now, cash isn't, it used to be what, a 70-30 split at a restaurant 5-10 years ago, 70% card, 30% cash. Now that splits 90-10. So cash is being less utilized in our world. You can see that from even, cash is a less secure, payment method with bills and things like that. You're either writing a check or you're giving them that account number or that debit card number to process your payment. So with that being said, I can understand the skepticism about doing it, and the skepticism about breaking into a new market or speaking to somebody about a field of expertise that maybe they don't have. I encourage people to tear that stigma down. I might know a lot about this finance stuff, but I know a little bit about a lot. I'm a jack of all trades, master of none, right? That's the other part of that. So be that jack of all trades and that master of none, and be humble enough to know when you need to ask for help, and be smart enough to know who you need to ask that help from. And not just because you ask for help doesn't mean you're getting it from a reliable source. That's why I put in some of those, reputable companies in my PowerPoint, as well as just a check source that you can go in and search information and make sure you're getting your financial information from a reputable person. So does that
Awesome.
answer your
Yeah,
question?
yeah, 110%. Thank you so much. Thank
You're
you so
welcome.
much. I think it was something I wanted to address in the chat, that I saw some folks talking about land, and and I think it's just a part of our cultural piece as well, to have that land, and that's a whole other conversation. But thank you so much, Daniel. Thank you so much, Ms. Hattie, for
Thank
being our
you.
moderator. And we're
Thank you.
really excited. Hopefully we'll see everybody on Saturday out of the tribal grounds at 1:30. Come out and experience more STEM, more Wampum talks. Daniel will be out there giving a class on finances and the game of life. So we're really excited to have that, and invite everyone out. So thank you again. We appreciate it, and we will see you later.
Yep,
Thank you, Ashley. Thank
Yep,
you.
thank you for putting this together, Ashley. This is great.
Thank
We
you.
appreciate it.